In 2022, Tesla investors watched their stock plummet 65%, but those who held Amazon through its 95% crash in 2001 saw it become one of history's greatest investments. Today, I'll show you why short-term market drama doesn't matter. Did you know that according to a 2017 study by the Brazilian Securities Commission, 89% of day traders lose money? Yet patient investors who buy and hold quality companies for decades consistently build wealth. Today, I'm going to show you why obsessing over short-term market swings is killing your returns and how thinking long-term can transform your investment results. The stock market is like a wild roller coaster. One day you're up, feeling like a genius. The next day you're down, questioning everything. I get it. I've been there. Back in 2008, I watched my portfolio crash 50% during the financial crisis. My stomach was in knots. I couldn't sleep. I was checking stock prices every hour. And you know what? I panic sold near the bottom, the classic amateur move. But that painful experience taught me the most valuable investing lesson. The daily, weekly, or even yearly price movements don't matter if you're investing in great companies for the long run. Let me prove it to you with real data. Take Amazon as an example. Since going public in 1997, it's had 6 drops of more than 50%. During the dot-com crash, it fell from $107 in 1999 to $5.5 in 2001, a brutal 95% decline. If you'd focused on those short-term swings, you would have sold in panic. But if you'd held on, ignoring the noise, a $10,000 investment in Amazon's IPO would have grown to over $8.5 million by 2023. Here's the thing. Great companies grow their earnings over time, and stock prices eventually follow earnings. But in the short term, stock prices swing wildly based on emotions, fear, and greed. Warren Buffett says the stock market is a device for transferring money from the impatient to the patient. The data proves him right. According to J.P. Morgan's 2023 market research, if you missed just the 10 best days in the S&P 500 over the past 20 years, your annual returns would drop from 9.5% to 5.3%. That's the difference between turning $10,000 into $61,685 versus just $28,229. And here's the kicker. 6 of the 10 best days occurred within 2 weeks of the 10 worst days. So, if you try to time the market, jumping in and out, you're likely to miss those crucial recovery days. The longer you stay invested, the better your odds become. Historical data from 1950-2023 shows that if you look at the S&P 500 on any given day, it's basically a coin flip whether it'll go up or down. But look at 5-year periods, and the market was up 87% of the time. For 10-year periods, up 93% of the time. Now, I know what you're thinking, but what about inflation? What about recessions? What about market crashes? These are valid concerns. But here's the reality. Every single market crash in history has been followed by new all-time highs. Every single one. The Great Depression? Recovered. The 1987 crash? Recovered. The 2000 dot-com bubble? Recovered. The 2008 financial crisis? Recovered. The 2020 COVID crash? Recovered. See the pattern? But here's the challenge. It's incredibly hard to stay calm when everyone around you is panicking. When the media is screaming about market crashes, when your portfolio is down 30%. This is where most investors fail. They let their emotions drive their decisions. So how do you overcome this? First, you need to change your perspective. Stop thinking of stocks as numbers that go up and down on a screen. Think of them as ownership stakes in real businesses. When you buy a stock, you're becoming a partial owner of that company. Second, only invest in companies you truly understand and believe in long term. If you believe a company will be bigger and more profitable in 10 years, does it really matter if the stock drops 20% this month? Third, never invest money you'll need in the next 5 years. This gives you staying power. When crashes happen, And they will happen. You won't be forced to sell at the worst possible time. Fourth, automate your investing. Set up automatic monthly investments into quality companies or index funds. This way, you're buying consistently, regardless of what the market is doing. You're actually taking advantage of market dips by buying more shares when prices are lower. Let me share a real example with verified numbers. In 2015, I bought shares in Microsoft at $40. Over the next few years, it dropped multiple times by 20% or more. But Microsoft's cloud business was growing exponentially. Azure revenue was growing over 50% year over year. They had a fortress balance sheet with over $130 billion in cash. So I held on and even bought more during the dips. By 2023, those shares were worth over $300 each, a 650% return, simply because I thought long-term and ignored the short-term noise. Remember this: the stock market is the only store where people run out screaming when everything goes on sale. But successful investors do the opposite. They get excited about buying great companies at lower prices. The key to successful investing isn't about having a crystal ball or making clever trades. It's about having the right mindset. Think like a business owner, not a trader. Focus on decades, not days. And most importantly, understand that volatility is the price of admission for the incredible long-term returns the stock market offers. If you found this helpful, hit that like button and subscribe for more practical investing wisdom that actually works. See you in the next one.